I'm Stephanie Link. I'm Chief Investment Officer at TheStreet. Here with me is Real Money contributor Dan Dicker. We want to talk a little bit about Exxon today. There's a lot of support for this stock, and yet you and I were talking offline, and we both aren't actual fans of this stock.
Yeah, that's right. I'd like to know I'd like to start with you. I'd like to know why you're starting to get a bad feeling about Exxon, and then I'll try to give you sort of the oil perspective into it.
So my big thing is that the stock has held in remarkably well, right, and that it's kind of the safe play in energy. And yet when you dig through the fundamentals, they've got very low production growth. And in fact, last quarter they declined in production growth. They're reducing their buyback. So everyone wants to own it because it's a great buyback program and a dividend play. Well, they're reducing their buyback program from $5 billion in the first quarter to $3 billion by the third quarter. And I think that's because they see they don't have growth, so they now have to change their capital budgets to trying to find more growth, and that's worrisome to me.
Now let me give you the oil perspective that supports your viewpoint on this. E&P, you're absolutely right. What's happening is that it's dropping the amount of money that they're putting into E&P, and where it is growing, it's all offshore. Now the reason that matters is that it's not domestic, and the point is that what's been happening in the oil markets is that domestic crude oil prices have been gaining in value compared to global prices. So the ones we've been talking about, the E&Ps that are domestically focused, are the ones we want. So we don't want the integrateds that are spending more money overseas than they are at home. That's the first reason. As the WTI, the domestic benchmark for crude, starts to gain against some of these other global benchmarks, what will also happen is that those who have refining exposure into the United States will lose their advantage. And Exxon has a ton of refining exposure, particularly into the Mid-Con, where once this advantage is lost, it will be really bad. So I suspect that their earnings per share for 2014 could be as much as $1 down from what the street is looking at right now.
And the stock is trading at 11 times forward estimates,
exactly,
which is a cheap multiple.
Well, especially when you compare it against peers.
Right.
It's very much at a premium. Now, you want to add the extra kicker on this. You know, the number one E&P company for natural gas in the United States, it's not Chesapeake. They're number two. Number one is Exxon, because of their XTO deal. Exactly, and that XTO
which they overpaid for.
They overpaid for. In fact, they're actually showing some losses against it on their balance sheet at this point, and that's going to go on for another year or two.
So to me,
in all ways, it's not a really happy stock.
No, it's not a happy stock, and we both agree for different reasons. But I would also say this one thing. One thing you said to me that's very interesting: they're spending on the offshore.
That's right.
That's good for an NOV, and that's good for a Schlumberger, and that's good for Baker Hughes and Halliburton and some of the deep water plays and Ensco. So I like to hear that. That's because those budgets are going higher for those companies, and I think that's more visibility for them.
Well, what we want those companies that are dealing domestically as opposed to overseas, in fact, over in the developing world, in Africa, over in Asia. And in those cases, that's where Exxon is really growing their money spent, and that's not going to work in their favor with this profile of crude that I'm talking about coming in the next year and two.
So we just see other places in energy to put your money. Great, thanks, Dan.